The nominal risk-free rate is best described as the sum of the real risk-free rate and a premium for. Well, we have a nominal, keep in mind we have risk-free rate here, real plus expected inflation. This is RF, right? Do we have expected inflation here? We do. Which of the following risk premiums is most relevant in explaining the difference in yields between 30-year bonds issued by the U.S. Treasury and 30-year bonds issued by a small private U.S. corporate issuer? And you may be looking at this and saying, well, these are government bonds, these are corporate bonds, so it must be a credit premium. And you look down the list and you find nothing. This is a very common question setup, and you may think, but the question is wrong. My answer is not there. It can't be right. It is just saying which of the following is the most relevant. Of these three, which is the most relevant? Yes, the most relevant would be a credit premium, but that's not your choice, and you don't get to write in an answer on the exam. You have to choose the three. Well, we're looking at difference in yields between 30-year bonds by the Treasury, 30-year bonds issued by a small private corporate issuer, 30-year, can't be a maturity premium. Since we're not told that these are real yields, we're going to assume they're nominal yields, and if they're nominal, they'll both have an expected inflation component in there, so it can't be that. It can only be liquidity. 30-year bonds issued by the Treasury. Treasury bonds are a very, very liquid market. 30-year bonds issued by a small private U.S. corporate issuer. First of all, it would be rare that you would have a small issuer issuing a 30-year bond because especially for private, they tend to be less than about 7 years for private debt. High yield debt tends to be less than 9 years, and publicly traded investment grade debt can be more than 15 years. So it's just a question setup. We're not going to question it too much, but just for your own benefit, it would be extremely rare that you would have a small company with a 30-year debt. However, because it is private, it would not be liquid. There's your liquidity premium. Consider the following annual return for Fund Y over the past 5 years. And we have 5 years and we have 5 returns. The geometric mean return for Fund Y is closest to. And how we get the geometric mean return is we add 1 to each return. We chain multiply them all, and then we'll take the fifth root and subtract 1, which is what we have here. There are the 5 returns added to 1. Take the fifth root, subtract 1. You should see this on your calculator. Use the y to the x key. Type in 0.2, because 1 over 5 is 0.2. Subtract out the 1. This is what you get, 14.896. We can see it's closest to 14.9. I preserve all 9 decimal places in the calculator. I encourage you to set yours to 9 decimal places as well, so that as you're going through the steps of calculating, when you get to the final answer, you haven't rounded off this and then rounded off that number to get another rounded off number here. You preserved all of your decimal places to the final answer, and then you can just cut off your final answer or match it up to A, B, or C. Here it's rounded to 1 decimal place, so we can see 14.89 is really 14.9. A portfolio manager invests $5,000 annually in a security for 4 years at the following prices, and we see we have different prices here. The average price is best represented as we have harmonic mean, geometric mean, and arithmetic average. We can get rid of the geometric mean right away because we have no returns, so we have no idea what the beginning value was and what the ending value was. So get rid of the geometric mean. It's the difference between harmonic and arithmetic, and we know when we have a situation like this, we can use the harmonic mean, which is calculated this way, but that's a lot of keystrokes. Can we find a quicker way to get rid of the arithmetic average? Well, if you add them all up, take the sum of all these, divide by 4, you will get $78, but we've already seen in the reading that that is just the wrong way to calculate the average. So while this is the correct arithmetic average, it's asking the average price is best represented as we would eliminate that. We don't even have to calculate the harmonic mean. It is best represented as the harmonic mean because we can get rid of the other two without calculating. But if you did calculate, you'd get 76.477. Again, I preserve all the decimal places, cut it off, 76.48. There you go. Which of the following statements regarding arithmetic and geometric means is correct? The geometric mean will exceed the arithmetic mean. Right away, we can stop. The geometric mean will never exceed the arithmetic mean. We don't even have to read the end of that sentence. It says here for a series with non-zero variance. If you have non-zero variance, and you do have variance, the geometric, you just reverse these two numbers. The arithmetic mean will exceed the geometric mean. So A is false. B, the geometric mean measures an investment's compound rate of growth over multiple periods. That is a true statement. Let's see if we can get rid of the last one. And by the way, in an exam, as soon as you get to the true statement, you're done. There can only be one correct answer. You can save time if you're in a hurry. You can save time by just not even reading C because you've already decided that B is correct. Let's look at C. The arithmetic mean measures an investment's terminal value over multiple periods. No, that is the geometric mean that does that, which looks like this, RG, present value. The return over multiple periods is the future value. The arithmetic mean does not have that relationship. That is a false statement. Okay, there is a very quick way of answering this question and a very long way of answering it. A fund receives investments at the beginning of each year and generates returns for 3 years as follows. And we can see that in Exhibit 1. Which return measure over the 3-year period is negative? A is the geometric mean return. B is the time-weighted rate of return. And we know that A and B are the same thing. Since there can only be one answer, if A is correct, that makes B correct because they're the same thing. We can get rid of A and B and only choose C, just by the logic of the answers. Do you follow that? If we think that A is correct, then we must say B is correct because they are the same thing. Since there can only be one right answer, the answer cannot be A or B because it would imply two correct answers. We would take C. We can test that here if we want to see what the geometric mean return is. You just chain multiply these and take the third root, right? There's the chain multiplication, and you take the third root, you get 7.967. It's positive. We're looking for negative. The geometric mean and the time-weighted rate of return are the same thing. You don't really have to calculate the money-weighted rate of return, but for practice, if you want to do it, you're going to need terminal values. We start the year at 1,000. We have 15%, which means we end the year at 1,150. It's saying here assets under management at the beginning of the year are 4,000. If we end at 1,150, we must have put in 2,850. 4,000 grows at 14%, ends the year at 4,560, but we began the year with 45,000, so we must have put in $40,440. Lost 4%, we ended at 43,200. Cash flow 0, negative 1,000. Cash flow 1, negative 2,850. Cash flow 2, negative 40,440. Cash flow 3 is 43,200. Compute IRR, or you hit the IRR button and then you hit compute. You get negative 2.22, and that's the one that's negative. However, for those that were quick on this, you would have seen that A and B are the same thing. Since there can only be one right answer, I got to choose C. I don't have to calculate anything. This is where the understanding of these two things, since I understand that they're the same thing, it's still a test of your knowledge of these concepts, right? Okay, this is another question in which we really don't have to calculate very much because we could just use logic. At the beginning of year 1, a fund has 10 million under management. It earns a return of 14% for the year. The fund attracts another net 100 million at the start of year 2 and earns a return of 8% for that year. So we can see that it committed almost 10 times as much money to a year in which it earned less. The money-weighted rate of return of the fund is most likely to be less than the time-weighted rate of return. Yep. Why? Because it committed the majority of the money at the beginning of the period that had the lowest return. So if we're going to weight the return by the amount of money, the greater weight will be on the lower return. Right away, we know that that's true. And then we have the same as a time weighted or greater than a time weighted. We could just use our conceptual logic to choose A. But if you want to see it mathematically, you're going to have a timeline. We start with 10 million. There's 14% return for the year, so that 10 million is going to grow to 11.4, and then we attract another 100 million. The sum of these two grow at 8% to end at 120.312. You're going to need that for your cash flows. Cash flow 0 is negative 10. Cash flow 1 is negative 100, but you can't get to the 120 unless you knew to add these two together, right? Cash flow 2 is 120.312. Compute your IRR. Your money-weighted rate of return is 8.53%. For your time-weighted rate of return, we know that we just chain multiply these and take it's 2 years, just take the second root. 1.14 times 1.08, take the second root, 10.959. It is higher than the money-weighted rate of return, but knowing the relationships between them, we could say, but we're weighting the lower return by more. Remember, money weighted. Where's most of the money? At the beginning of the year that earns the lowest return. We're weighting the lowest return by significantly more. So yes, it will be lower than the time-weighted rate of return. An investor is evaluating the returns of 3 recently formed ETFs. Selected return information on the ETFs is presented in Exhibit 20, which ETF has the highest annualized rate of return. Time since inception and return since inception. So ETF 125 days earned 4.25. What is that annualized? Well, since that's a return since inception, we don't have to divide it by anything. It is 4.25 for 125 days. 365 over 125. Take out the 1 because we added the 1. 12.922. Next one is 8 weeks, 1.95%. So there's our 1.95% added to the 1. Since it's 8 weeks, it's 52 over 8 minus 1, 13.37. And the last one is 16 months, 17.18. So 1.1718 to the power of 12 over 16 because it's months. Our months are always in the numerator, and then the period is in the denominator. This just happens to be more months than 12. So our power term will be less than 1, which will lower the return because, of course, we want it over 12 months, not 16 months. You get 12.6263, highest return here, ETF 2. The price of a stock at T equals 0 is 208.25. T equals 1 is 186.25. So we can see that we had a negative return over that period of time. The continuously compounded rate of return for the stock is closest to, and that is the natural log of PT over P naught. PT 186.75, P naught 208.25. Divide these two, just hit LN on your calculator, take the natural log, you'll get negative 10.8968%. 10.9%. It won't say negative 10 point, you'll have a decimal place in front of it. A $25 million equity portfolio, and we can be confused here. If it says equity, we're thinking, well, is that VE? It should say equities, an equities portfolio, so that there's no confusion as to what we're referring to when we say equity. It's not the equity that we have in the portfolio. It's a portfolio of equities. $25 million portfolio of equities is financed 20% with debt at a cost of 6% annual cost. So 20% is $5 million, which means we have $20 million in. If that equity portfolio generates a 10% annual total investment return, the leveraged return is, and we know that is the return on the portfolio, multiplied by a leverage factor times the differential between the return and the cost of borrowing. So it earned 10%. There's our return on the portfolio. What's our leverage factor? It is the value of the borrowed funds, 5 million, over the value of the equity. Well, if we borrowed 5, we must have had 20, right? That's why I find this a little distracting. So it's 5 over 20, and the differential between the return, 10% and 6%, is 4. So it's 10% minus 6% multiplied by the leverage factor added to the portfolio return, 11%. There we go, 11%. Okay, this question I'm going to pick on because I think it's just bad grammar here. An investment manager's gross return is an after-tax. Well, we can stop right there. The gross return is a pre-tax return, not an after-tax. We don't even have to read the rest of that sentence. It is not an after-tax nominal risk-adjusted return. B, the return earned by the manager prior to the deduction of trading expenses. No, it is the return earned after the deduction of trading expenses, but prior to the deduction of management fees, custodial fees, etc. So we can get rid of B. You can take C as it is. You don't even have to read it because there can only be one right answer. There must be one right answer, and you've gotten rid of A and B. But C has a grammatical error which I don't like in it. Is an often used measure of an investment manager's skill because it does not include expenses related to management or administration. It does not exclude expenses related to management or administration. It is a measure of an investment manager's skill because it does include expenses related to management or administration. So you have your gross return, right? Which is the return on all of the assets. And then if you subtract all of your expenses, you get to your net return. So to say it does not include, the net return does not include. The gross return does include all of that stuff in the return. I get what the author was trying to get at because it doesn't account for all of that stuff. Okay, I get that, but it either does not exclude expenses or it does include expenses. Saying that it does not include expenses is technically wrong. Grammatically, it's wrong. And from a strict logical point of view, it is an incorrect statement, which would leave no answers. But we've already eliminated A and B. We know C is correct. It's just bad grammar. The strategy of using leverage to enhance investment returns amplifies gains but not losses. It amplifies your losses too. That's what leverage does. It's beautiful on the way up and painful on the way down. Doubles the net return if half of the invested capital is borrowed. It doesn't double the net return because if you borrow money, there's a cost to borrowing the money. So it doesn't actually double your initial equity return. It enhances your equity return, but it doesn't double it. So we can get rid of that. I should have put an X on that, not a check mark. Increases total investment return only if the return earned exceeds the borrowing cost. Yeah, that's true. There we go. At the beginning of the year, an investor holds 10,000 euro in a hedge fund. The investor borrowed 25% of the purchase price, which is 2,500 euro, at an annual interest rate of 6% and expects to pay a 30% tax on the return she earns from his investment. She earns from his investment, there's a lot of this kind of sloppiness going on, right? At the end of the year, the hedge fund reported the information in Exhibit 2. We have gross returns, trading expenses, managerial, and administrative expenses. So we know the gross return does not include trading expenses. Those were already paid, so we can ignore that. So we have a gross return. But the investor gets the net return, so we're going to have to take out the 1.6. So let's do that right away. We get 6.86% net return. Now let's calculate what our levered return is. It's the return on the portfolio multiplied by a leverage factor. We borrowed 2,500. We invested 10,000. Well, we didn't invest 10,000. We held 10,000, which means we must have put in 7,500, and we borrowed 25 to get to the 10. So I just take out all the zeros. 2.5 over 7.5 is the same as 2,500 over 10,000, right? And the return minus the cost of debt, we get the 7.4166666. It goes on and on. And since we have a tax rate of 30%, we get to keep 70% of that return. So we multiply by 1 minus 0.3, 5.0026, 5%.